make sure everyone's. Okay, see lots and lots of ones. Looks like everyone's hearing me okay. We're going to go over some stocks today and look at some of our past trades, and also mainly we're going to talk about investing versus trading, or holding for longer term gains versus trading shorter term gains, such as swing trading, short term trading versus position trading. Now, you know, we'll generally get questions asked and emailed to us when we, you know, take a small gain and the stock, when I say small gain, let's just say 10%, and then the stock runs up and goes up 15 or 20 or 25%, you know, we'll get emails saying, why didn't you hold it? And then the same holds true for when we you know, don't take a profit at 10% or 12 or 15%, and the stock comes all the way back and stops us out at break even. Then we get people saying, why didn't you sell it? Well, the fact is that there is no crystal ball. You know, we don't know where the stock's going to go for certain. Nobody knows that. So the question is, what kind of rules can we have to give us a chance to capture a good amount of profit versus what we risk, and try to stay with the stock? And that's what we're going to discuss today. The first thing I want to say is, remember that the goal of trading stocks is not to get the high or the low in a name, but to make more than you risk consistently. That's really what it's all about, and to take as small risk as possible. So really what you're trying to do is consistently turn over an edge, and this is something that I think a lot of people end up getting confused with because of Monday morning quarterbacking and looking at later on at what the trade would have done, and saying, well, I should have sold it here, I should have bought it there. Yes, that's true. You should go back and do post-analysis and try to improve your techniques. But it doesn't mean that just because the stock went higher, you didn't make a good sale, or if it went lower, you didn't make a good buy. So let's take a look at that. We want to start off here. First thing we're going to talk about is the main priorities that I have with trading in any position. The first priority is my risk, or what would be my stop. And that's the point at which I'm going to cut my loss. So my trades that I go into are in large part based on, or at least at the very end, the final decision is based on what type of risk that I'm taking and what type of stop loss risk that I have. So for instance, if I'm going into a trade and it sets up into one of these 3C contraction, volatility contraction setups, and whether you're trading off of technical setup, it has to justify me getting in there that I'm going to be able to allow that stock to act normal and still be able to hold in the position. Otherwise, I'm going to use a percentage stop and use a reasonable stop based on what my own trading produces on the gain side. Of course, if I'm taking 10 or 12% gains on average, that's my average gain, and I'm only right 50% of the time, then I certainly can't take 10 or 12% losses. No matter how good the stock sets up or the pattern looks, I have to make those losses smaller than that. So I'm always going to back into that risk. That's my very first priority. Now, once I'm in that trade and it starts to move away from my buy points, I then want to protect my break-even point. I want to move that stop up as soon as I can without choking off the trade. So if the trade moves up, stock moves up 2, 3, 4, 5%, I'm not going to move my stop to break even. That's too soon, and that's going to choke the trade off. I'm not going to allow it enough time for fluctuation or space for fluctuation. But once I get up and I start, and generally what I measure that by is when I start getting up into the 8, 10, 12% range, or I get past what my average gain generally is, at that point, I regard that as a decent sized gain. And what I want to do now is I want to protect that gain, or I certainly want to at least protect break even. So once I get up and I get it into where very often I'll go through the first natural reaction, and then when I take out the high in that natural reaction, a lot of times that'll be at a point where the stock is up 10 or 12 or 15%. At that point, I'm going to move my stop up to break even or near break even. Now, the third priority would be to, now I want to nail down a profit and make sure I don't give back what I've done this work to get, and I've taken this risk. So now I'm looking for a spot to get out of the trade without giving up too much of my gain. Now, the thing that people get into, and the emotional trap that we get into, is this fear of regret. And what it does is it puts traders into a mindset of having two emotions that we fluctuate in between: indecisiveness and regret. Before we put on the trade, we're always wondering, should I buy it? Or if we're in the trade, should I sell it or should I hold it? Once we're out of the trade, then we're looking back saying, I should have bought it, or I should have held it, I should have sold here, or if we didn't get in the trade and then the trade takes off, I should have bought it. Now, we're not able to make every decision perfectly, of course, but this whole cycle here is a very vicious emotional trap that you have to learn how to protect yourself from. And it, like I said, it stems from the fear of regret. And this whole regret cycle is from Monday morning quarterbacking as opposed to doing post-analysis. Post-analysis is to look back and improve upon your techniques. It's not to look back and say, well, if the stock goes up more and I sell it, oh, then I made a mistake. Not necessarily. Stocks may go up by double from where you sell it, but there's no real way of knowing. It's all about probabilities, of course. So here's what happens. You sold a short-term price advance, right? So you sold it here only to watch the stock then go and take off. So now you're saying to yourself, well, I should have held on to that. Or you didn't sell here and you didn't nail the profit down, and then the stock rolls over, comes all the way back, stops you at break even. Now you're saying, boy, I should have nailed that profit down. You're basically in the same situation here. So I'm going to come up with a few rules here. We're going to talk about how we can hold some of these stocks and also get a blend of trading around your positions. That's where you can try to get the best of both worlds. If you're a beginning trader, I wouldn't suggest that you try too many complex types of strategies where you're trying to blend longer term and short-term trading together. It's much more difficult, and you really got to make a decision as to how you're going to approach things and what's best for your personality, which we'll talk about in just a minute. Now, as a trader, what I normally do is I go through 1 to 2 natural reactions, and then I sell the stock, or I try to sell the stock into strength as the stock becomes extended on a short or intermediate term basis. We're going to show you some examples of that, which I've done recently. I won't always wait for the natural reaction. Sometimes I'll just sell right away if it just runs up real quickly. That's from a trading perspective. Now, from more of an investment perspective, which I'm more likely to do in the beginning of a bull market after a bear market. Have a long bear market, and then we start to move up into a new bull market. This is the spot where you want to start thinking more of holding some of those initial leaders, because you might be on a key leader that could make a tenfold move at that point. There's some other scenarios that I'm going to talk about today that you might want to try to hold for bigger moves. So we're going to be able to narrow down some of the higher probability or the scenarios that have a bigger magnitude potential. So if you're going to go for a big move, you're going to have to hold through major corrections, and most likely there's going to be some undercuts of some significant lows, and also you'll have to allow the stocks to go through several base building periods, usually 2 or 3 or more base building periods. So that could mean that you buy a stock and it goes up 20 or 30%, and then it pulls all the way in, and you might only be up 5% or even all the way close to your break even, and it goes through a base building period. It does nothing but go sideways essentially for 3 months, sometimes even longer, sometimes 5 or 6 months. And then from there, the stock will then, of course, in some cases, reemerge, and that's what you'll have to go through to for those really big moves at times. Now, the question is, what is the opportunity cost? And this is where you have to sort of make a decision as to what your style is and what you're trying to achieve. But if you could find stocks, so let's just say your style has produced the type of results where you may be able to find in 120 days a 40% gainer from time to time. But in that same time, if you could get 6 to 10% gainers, you might be able to get a bunch of 10% gainers. Which is easier to find, a stock that goes up 40% or a stock that goes up 10%? I think it's easier to find a stock that goes up 10%. And I know in 120 days, I can find a handful of those. So now if you compound those 10% gains, and of course 120 divided by 20 days is 6. So in that time frame, if you could get yourself 6 10% gains, well, instead of a 40% gain, you've got a 77% gain. One stock at 40% or 6 stocks at 10% compounded out. So when I first started trading, commissions were very high. They were $150 per trade. You have to sometimes $175. You have to spend $350 just to make a round trip, and I didn't have a whole lot of money, so I was looking for doubles and triples just to get out of the gate. But as commissions came down, it allowed for stock traders to trade in and out much more rapidly, and that's where the birth of short-term trading came, the SO's bandits, and when we came into the 90s, it got very popular, and that's because of the commission structure. So that allows you to be able to do that now. Now, here's a situation where this is Medivation, and we traded this stock as it came, and I'm just going to zoom up on it here. We had this pullback here that was a natural reaction. Sometimes I'll trade these natural reactions after a breakout, after a base breakout. You come back down, and then I'll trade very close to where I think the stock should start finding support. And as it turns up, I'll play that pullback buy. And this is what we call trading near the danger point. So at this point, if this stock were to come off much more, it would be too much. It would be excessive, and it would be suspect. So I go in there knowing that this has the potential to move up much more than 6%. And in this case, you'll see just in 9 days, it went up 45%. Now, in a situation like this, I'm definitely going to take something off the table. There's no doubt that I'm going to take some profits here. I'm not going to allow this to slip back. It's just too big of a gain in such a short period of time. Doesn't mean that this stock can't go much higher, but in a situation like this, I'm probably going to take off at least half the trade as it moves up here. Now, another way that you can try to hold in a trade is what we call the 50-day rule. And this is where you start off with a regular stop, whatever your stop may be. Let's just say at this point, you buy here as it breaks out, and your original stop is, say, 5 or 6%. Now, the rule states that as long as you don't get stopped out of your original stop, when the 50-day gets to your break-even point, you see here the 50-day catches up to the break-even point. When it gets to the break-even point, you now switch over to the 50-day, to a close below the 50-day, or your break-even point. So it's break-even or better at this point. So then what happens is you turn your break-even stop, turns into a moving trailing stop. And you'll see in this case, this was forward. I actually traded this stock and sold it into this first rally, and then rebought it as it rebased here and bought it again coming out here, and then sold it into this rally. So I traded it twice instead of holding through this base building. But again, you can see the 50-day rule would have kept you in there, and then you would have gotten knocked out over here as you close below the 50-day, and you'd locked in a 40% profit. I chose to just sell into the strength, and then, of course, I didn't know it was going to rebase, but once it did, I got another opportunity, and I traded my way up. Now, there's a lot of different ways you can do this. You might sell a portion of your position, and then as it goes through this base building period, you can then add that position back while you put the 50-day rule on the half that you kept. So that's another way you can approach this. Here's another stock with the 50-day rule. Let's just actually zoom up a little bit here. This is Foster Wheeler. I actually traded this coming out right here, and you'll see as the 50-day catches up here, this is where now it becomes break even or better, and now the 50-day moves up and becomes a trailing stop, and over here is where you got knocked out for a 70% profit. Now notice, to play this for a larger move, you see how you undercut a major low here, and you really come off pretty hard. This is a pretty significant decline. I mean, you've given back quite a bit of your previous gain. And this is what I was talking about in the beginning, that you're going to have to go through. If you're going to play a stock for a really big move, you're going to go through corrections along the way. Now, some of you could stomach that, and you'll find that that'll pay off, because a big winner will pay for a bunch of names that stop you out, or move back to break even. My particular style is I'm really not I'm not one to be able to allow stocks to go down much once I've gotten a profit, especially if I have a decent profit. I'm not willing to let them come off very much, so I just sort of choke them off as they go up, and I'll get a lot of trading opportunities, but I'm not generally trying to stay in the stock for a big huge move. And when I say a big huge move, I mean this is a huge move. If you just sold it into strength, you could have made more than 70%, a double, in just 4 or 5 months. Of course, is a huge move. But some of these names go on, and you get 50 or 100% on them in a 1 or 2 or 3 quarter move, and they go on to go up 5-fold or 10-fold. Now, here's a name that we bought back in May of 2013. Symbol was ACAD. It came out of what we call a power pivot setup, or a power cheat. You'll see that in this particular scenario, we're buying it coming off the low here with this pivot point that's set up, and as we ran up here, you were able to go through a base building phase, break out, and go through another base building phase, and then break out, and you never really had any pressure put on you. So if you had set your stop here to break even once the stock moved up, it never came anywhere near there, and you never really rolled over. You just kept moving higher and higher here. So that was one that wouldn't have put much pressure on you and would have kept you in the trade. Now, something like SCTY, which, of course, this has been talked about quite a bit most recently, and I know we actually discussed this over here as it was coming up this right side, but our original purchase on this was right off the primary base, way back here, as you can see. I mean, it's gone up. That was about 11 months ago, and it's gone up 330% since then. So here I've just put in a few things. One, here's the break-even point. So once the stock gets away here, it did come back down, but it did not hit the break-even point, so you would have kept yourself in there. And also, you can see here, this is the 50-day rule. If you were switched over to the 50-day, you've been held in all the way till this point. However, you'll see you have this big run-up, and this is the climax run. So you certainly wouldn't want to wait for the 50-day rule if you had a run-up like this, and you were able to get yourself so of course we came in around $15, and this ran up to almost $55. So you're talking about a 300% move here. So you pretty much would have wanted to sell into that, I'm sure. And I would have sold a lot earlier, of course. But this is something that you can see has made a very large move. Here's ING. Now, I want to point something out here, and that is that there's 2 particular types of setups that if you're going to try to hold for big moves, these are the 2 types of setups that you really should be focusing on. The first is what I just showed you previously. Let me just go back here. One would be the power play setup. When you get these power plays where they run up and they double in a short period of time, and they give you that high tight flag setup, those are stocks that can go up 100, 200, 300% in just a number of months or a year or so. So they have incredible potential. The other is the IPO base, which is the primary base. The reason, and I call the former the power plays, I call those velocity plays. Those are velocity setups. And the IPO bases, those are magnitude setups. Both of them have incredible potential. One has the potential to make a huge move in a short period of time. The other one has the potential to make a huge move, period, because you're getting in right near the beginning of the stock's life. So if you are, in fact, going to find the next Amazon or the next Netflix, you're very early. You're very early, and that's why you always want to look at these primary bases very carefully and try to get involved in them as they emerge. Now, one of those primary bases that we highlighted here, we actually bought and we traded was ING, which is the U.S. Spinoff of ING, which is simple as VOYA. And we bought this right here as it was coming out of this base. I remember I actually showed that this looked very similar to Amazon when Amazon came out of its IPO base. And it came out very nicely, just ran right up. And we sold it. We took a short-term profit, and that turned out to be a pretty good spot to sell because it sold off shortly after. Went through this base building phase. Now you'll see if you had just moved your stop to break even, you would not have gotten knocked out there, although it would have triggered a 50-day rule if you were to use that rule. And of course, like I said, you could use that on half the position, sell half your position into some strength, use the 50-day on the other half. Then of course you see it set up again. It broke out here. If you remember, for those of you that have been with us, it gapped out here, and we actually didn't buy it because it gapped out. And then most recently, we've been looking at it here, and you'll see it set up again. So now you're on your third base here. So again, if you were buying this here and you were still going to hold in this, maybe you sold some of your position, you held some of it for a larger move, you're now 1, 2, 3 bases. And this is what I was talking about, where you're going to have to go through these base building periods. You'll see here you would have gone through 1, 2, 3 months of base building. Now you've gone through 2 months of base building, and this will just continue to progress up because stocks don't go straight up. Although GENT, as shown here, is one that definitely defied much base building and did go pretty much straight up. And this is why, again, there's a few things you don't want to ignore, and that is the power plays and the smaller cap power plays. And these are the ones that people actually are most afraid of. Traders are most afraid of the smaller cap, thinner names that are the power plays because, first of all, they look like they're in the stratospheres. I mean, if you go back and you look at this stock and you were looking at it over here, it looks pretty high, especially if you look at the price. Let's see, the price went from $7 or $8 up to over $20 in just a month or so. But that's precisely what we're looking for. And this came out of that power pivot right off the low there, set up that right side, and you'll see this is one that I really if I were to go back and grade the trade, I get an F on this one, even though, and this is what I was pointing out before, even if you make a decent profit, doesn't mean you did the right thing. And even if you lose on a trade, doesn't mean you did the wrong thing. You might be taking a great loss and taking a terrible profit. In this particular case, I took a terrible profit. At the time, we weren't having a whole lot of success in the market, and I was just happy to be able to get a 20% gain. And as this ran up this right side, I just sold it, just trying to balance out some of my losses that I had in my portfolio. And, of course, this turned out to be a really huge winner. It just got taken over, so that's why it's just sort of died here. But as you can see, this stock went up 200% in only 3 months, and this is that velocity setup that I'm talking about. Again, here, just moving your stop to break even and free rolling would have kept you in a name that never came anywhere near the break even, nor the 50-day up until it got taken over. Now, there's a few things that you can do for trading around your positions or trying to hold for a larger gain. Let me just make a note here. And we want to point out that we're swing trading and doing more short-term trading on the platform and trying to give you the tools and teach you to do to trade and position for yourself according to your own goals and your own personality, but we have to constantly keep flow going and have trades, because it's really an educational platform. That's our main focus is education, and of course we're trying to maintain and maintain profitability on the trades that we give you. So so you can earn while you learn, as we say. So the decision to hold these stocks for bigger moves, you should try to play the better names for bigger moves, and with a portion. And even if you buy or sell, let's just say you buy 1,000 shares of a stock, and it gives you a really great short-term gain, you're up 15 or 20%. You could sell 90% of the stock and keep 100 shares, keep 50 shares, and then use that to practice holding the larger gains, which it won't put too much pressure on you emotionally or financially, but you'll still get the practice, and you'll get more confidence to maybe hold more stock and to maybe not sell as much once you get some experience doing that. So it's what David Ryan calls a mental health buy. When he sees a stock that he buys just a small position, so he has a piece of it. If it takes off, this is sort of a mental health hold. So if you think something can be a big winner, and you sell off a good portion of it and then hold the rest of it. Now, there's a few things that I recommend, and one of the reasons why you'll see sell half, sell half, sell half, there's a reason why everything is based on the sell half. And some of you have heard me say this lots of times, but selling half puts you in a win-win situation, which no other amount of selling will do. For instance, if you sell 75% of the stock, if it only goes in one direction, you're right. If it goes up, you're more right than you would be wrong, of course, if it goes down, or vice versa. But if you sell half, you're right either way. You're equally right either way, I should say. So if the stock goes up, you mentally can say to yourself, thank God I held half. If it goes down, you can say the exact same thing. Thank God I sold half. Either way, you're in a win situation where the decision that you make is rewarding just as much as it's not. So what I generally do is I either sell half my position when the stock runs up and I have a decent gain, and I just maintain my original stop. That's if I really want to give the stock some room, especially I might do that if the stock hasn't run up a whole lot. If it's run up a real lot, then I'm not going to give back a really good gain. I'm going to move the stop up. Which would be where the other one would be if I would sell half and then I would raise my stock to break even. That's usually when I'm trying to protect a decent gain. And then we're going to look at a few examples. We just did this with AMTD and Splunk. And then the sell half and cut stop in half. This is sometimes where if I don't want to choke it off and I think it's a little more volatile, sometimes I'll sell half, and instead of raising my stop to break even, I'll just raise my stop by half. So for instance, if I have a 6% stop, I make it a 3% stop. So it gives me a little room for if that stock comes back and it comes out of a very obvious buy point, there's a lot of people that might go in there and set their stop around break even. So what I'll do, and I'll also do this in names that I think are what I call crowded. If they're bigger cap names and I think they're crowded, are what I call crowded. If they're bigger cap names and I think they're crowded, I want to try to get away from obvious points where there might be a lot of stops gathering around. So I might just move it up in half. I want to give it a little bit of room. This is that particular situation I was contemplating on BABY. I did not do it, and it turned out to be a wrong decision, which I put it at break even, and we got stopped out of it. We're going to look at that in just a second. And then the other thing that I look to do is I look to add back on follow-up setup. So I might sell half, and then I want to trade around my position. So if the stock resets up, I'll add back my position, and we're going to look at that too. So first, let's take a look at AMTD. Just pull that up here. Which, of course, we're still in. Here's the buy point right over here. Now, at this point, we've moved up. We've come back to a natural reaction. And as I said, once we have a natural reaction and we move back into new high ground after the natural reaction, and in this case we moved into new high ground, we sort of wedged up a little bit, and we've moved into new high ground again. We've actually moved into new high ground 3 times now, three stabs to the upside here, and we're starting to accelerate here. So I'm definitely going to move my stop to break even though I'm not up a lot on this. We're up about 6.5% on the trade right now, but I'm going to move my stop here to break even, and I'm not going to let myself lose money on this trade, particularly because this stock should hold. It shouldn't come all the way back down to where it broke out to. These names have been acting really well. E-Trade has moved up considerably. Schwab bounced off the 50-day and had a nice snapback here. So this group still looks good. So I'm moving my stop to break even here. Now let's see. Just gotta go back here. Splunk, who's the other? That's right. Let's see the other example. SPLK. Now with Splunk, this is another situation where you'll see we bought it right here. Now it immediately came off for a few days, and if it came off much more, we would have gotten knocked out. But I held to my original stop, and now it's moved up here quite nicely. It was able to pull back. It went through on this day here, went through I believe it was a downgrade, and was able to close right at the high. And I would put this as a pretty significant low right now. So this is another situation where I'm going to move my stop to break even because it's just below this low here, which I think should hold. We're trying to turn up now from this first natural reaction. And at this point, you know, I almost bumped my position here as it started moving, but we just didn't get the type of, I wanted to see it really start to move and see some volume come in. The volume was up a little bit from the previous day, but still below average. So I would watch this here. Maybe if we pull in and we tighten up, you start moving up, you can add to it, or if you don't own it. So again, I moved my stop to break even on that one. Now, on the sell half and cut stop in half, let's take a look at the VABY scenario and how that was handled and how we could have handled that. Now, here, my original stop was down here around this low. This is where when I first went into the trade, this is where my stop was. Now, as you know, we report the stops as being only good for the day because I reevaluate the position every single day. So I may change my stop. It depends on how the stock's acting. But we broke out above this level right here, and we're up about from the breakout. It's only 2 days, and it doesn't look like much, but this was I don't know, a 10% gain or so. So it was a fairly decent gain. I was grappling with either moving my stop to break even or cutting it in half and moving it here, which, as you can see, we would have stayed in the trade had I done that. And this is what I was saying about names that are volatile or names that might be a crowded, that you deem a crowded trade. I did not think this was a crowded trade. It didn't feel, you know, this is a smaller cap, power play type situation. I don't think too many people are on this, relatively speaking, compared to a big cap name. So I felt like this could maybe hold up here, but we had a little shakeout here. It came right down, you can see, right down to the stop, right to the break-even point, and then turned right back around here. Let's look at adding back WWAV. Now this is really sort of a textbook situation where this is how I like to trade optimally. Is I like to trade a stock that just keeps moving up and rebasing or pulling back and buying the breakouts, selling them when they get extended as they pull back in and give me a pullback buy, a reset of base, buying as they start to turn up again, selling as they get extended again. I sold this, as you can see, a little early here, but as it bumped against this old high here, that's what I got out. I said, let me just sell it here and take this profit. I was able to get in and out and in again. So we racked up a little bit of nice gain in this. Since then, of course, it's gone even higher here. But that's the type of scenario I'm talking about here, where I'll look to add back, and then we have WETF. And I always like to look at the situations that I handle well and they're profitable, and also the situations that I either handle poorly and they're not profitable, or the ones that were profitable and could have been more profitable. And this particular situation, the WETF, we really bought it just right as it had this pullback buy that wedged way in here, came up, and on the very first day we had a really nice gain. And as you can see, We made another high the next day, even though it closed down. We had a reversal recovery. And just 1, 2, 3, 4, 5, actually 6 off the low. 6 days up here, with the exception of these little stalling out. That's a really good sign that the stock is under accumulation. See, the volume came in. That's what you want to see. That's usually the best sign that you're going to make money, is that you're seeing multiple days come in. You're not just one breakout day and then it craps out, but you're having follow through. Now, I sold this as we came up to this old high, just got above it. You can see here we stalled out at this high. We had this reversal on earnings. Then we came back up against it again, and then we had a pretty good sell-off here, although the volume wasn't too high. And as we came back into the mid-range of that sell-off, I got out. And the mistake here was not buying this stock back as it came back out, although we did put it on breakout alert and highlighted it. We did not buy this. I didn't buy this stock back, and now it's moved out again. And you can see here, this is another one that had some news, and it came all the way down and still just came of the break even. So if you moved your stop to break even, you'd still be in this. It just came just down to close to the break even point. And again, another one where maybe your initial stop is down here around this low. As it moves away, you bring your stop and cut it in half, and bring that stop up. And now you give the stock enough room to come back and put you at a small loss, maybe 1, 2, 3%, but let it come through that break-even point and not still stop you out. Let's look at a few other things here. Go through a few names. ISIS. So we bought this one here the next day where it stalled out, had a reversal recovery 1 day later, and then we added to the position. And then over here, as it drifted back, I actually peeled some of the position off, and you'll see this is just classic. This is just classic bending with the market, bending with the market to you know, if I'm getting in there and I'm overweight and the position starts moving against me, I'm not going to keep my overweight and let it get me at a loss. I wasn't overweight. I had a full weight position here, but we came back, and you'll see this came back to just underneath where my second purchase was. So I got myself at a little loss on that second half, and I trimmed it off. A few days in here, we're going to come close to actually getting stopped at the second part, and then we just took off right here, and I sold it to the strength as we got short-term extended. Now again, you know, this is a situation where as you run up here, you can move your stop, bring it to break even, and move your and play it. Sorry about that. Let's take a look at WebMD. This is one that just kept going here, and it's still going. And again, I want to look at some of these that a few things could have been done here. And looking post analysis, the first pivot that we bought was absolutely perfect. We bought it just right, coming off this low. You'll see it undercut this low, and then you'll see that we get some volume here as where it closes up. It drifts back here, closes in the upper range, and then we break out. But you'll see the volume's pretty low. So, and we didn't get any follow through. It didn't mean that you should sell the stock right then and there. It just meant that it probably was going to need more time. And you'll see it move sideways, and tightened up quite nicely. And then we broke out again. This is where the ad should be. And if you didn't own it, this is where you could be buying it. And then as we run up here, of course, we took a quick profit on it, and the stock's still moving even higher here. So again, in a situation like this, you'll notice we have not even gone through the first natural reaction. So this was definitely sold very quickly, maybe too quickly here. I would, if you want to try to play these for bigger moves, what I normally do is I try to go through that first natural reaction, and then as it takes out that high and can recover, I want to see if it can move back into new high ground. Then I make a decision if it starts to get short-term extended and starts to really run up, whether I'm going to sell into strength and nail down a profit at that point. So again, you could have sold just a portion of your position and then move your stop. You'd still be in in this name here. ETFC, another one. Now, of course, I want to point something out here, and that is we're looking back here, and we're Monday morning quarterbacking a little bit if we say, well, we should have done this. Well, it's okay to look and look at the technicals, and if the technicals say you should have done something, fine. But just because it was a gain or a loss doesn't necessarily mean you should have done something. You know, if we were looking back and the market rolled over and all these stocks got cracked and everything was way lower than where we sold it, well, then it'd be looking like we made a great decision, right? So again, you can't get too hung up with saying, you know, whether this was right or wrong. Did you make money? Did you make a profit? You know, if I took a 4% risk and I made a 12% profit, that's a pretty good risk-reward ratio. And if I can do that over and over, you're going to make lots and lots of money. So that's, now, of course, you want to try to optimize and make as big gain as you can. But if there's a time factor, like I said, if you're holding one stock and it takes X amount of time to make a certain percentage gain, if you're trading into other names, it doesn't really matter. I mean, whether you're in X name and you hold it and it goes up 20 or 30%, or if you're in that name and you roll out at 10%, you roll into another name and it goes up 10%, you're in the same spot. It doesn't really matter. It's really your style. You have to realize, though, if you're going to try to hold one name and try to play names for a bigger move, you're going to have more probably disappointments, you know, where you're going to give back a good portion because you're trying to stick through those swings. So you really have to make that decision now for yourself. In this particular scenario, you'll see I did allow this stock to go through a few normal reactions, and we bought it right here as it broke out. It only had a few days where it came in, certainly not enough to knock us out, and then it recovered right into new high ground. Now here's your first natural reaction. It pulls in for 2 days, moves sideways for 3 more days, and then back into new high ground. Runs up a little bit. You'll see here it's moving sideways essentially for 1, 2, 3, 4, about 6 days. Just comes off for 2 days, back into new high ground. Now we're in the same scenario again. It just comes off for 2 days. Third day here turns up back into new high ground. So now we're on our third natural reaction. So you'll see this is what I talk about. You can read this in my book about natural reactions and reversal recoveries and having you stay with these names as long as they're acting normally. Now this one here, of course, we ran up here for a few days, and as it got extended, we had 2 natural reactions, got extended. I took the short-term profit there. GT, another one. Let's take a look. Now, this is a scenario where this is a big cap name. Big cap names I'm even much more inclined to take quick profits on because they're not as inefficiently priced as something like a GENT. You know, a GENT that's coming out of a power play, it's anyone's guess on where that could go. It's probably completely underfollowed, very inefficiently priced because there's just no analyst or very few analysts following these companies when they're small. But when you get a company like Coca-Cola or IBM and they have 40 analysts following them, everybody, it's not a secret, everybody knows about it, and they're much more likely to be more efficiently priced. And when they get those aberrations and they run up, these are the type of stocks that you're better off trading into the strength and then buying the pullbacks, looking for the pullback buyers. It comes back in. If you like the name and things are still holding up and the fundamentals, everything looks good, you try to trade around the position or at least trade out of some of the position. In this particular instance, I came into it here, took a half position. The next day, it followed through, I don't know, a small gap, and I moved to a full position. And you'll see it moved up for a few days, moved sideways, then broke out here, and now you're looking to go through some sort of natural reaction here, and we'll see how deep it is, if it can come back here much more or not. And I would look for a pullback buy at this point. And I actually scaled out of it on this day here. It was the 9th, and it has gone up 1 day since then. Let's see, what else? Now, PCRX, if you remember PCRX, this ran up. This is one of those scenarios where this is what I call the gift. You know, when you get 20% or 30% in a day, generally what happens, if it happens in the morning in particular and it gaps up, runs up, I usually just sell right into it, or I start watching it very carefully and sort of trail it up. I kind of switch over to my intraday hat, and I might just put a trailing stop on it intraday. I don't want to give up, that type of quick money. Sometimes it could turn into something that just explodes and goes up much more, but more often than not, it's usually a good idea to nail some of the profit down. But again, here, a situation where could have sold just half of it into this move and then move your stop to break even, and now you're free rolling. And the chances are that if you get something that moves so extraordinarily and moves up so rapidly, the chances are that you might be onto something that's something that's happening that's really special and that maybe just isn't apparent yet. So those are the ones that, again, you might want to just sell a portion of and then try to hold for the rest of it, and you move your stop to break even. Now you're free rolling, and even if it stops you out, if you've got a 20% gain on the stock, you sell half of it at 20%, and it comes all the way back down, and it stops you out at 10%. At break even. You net a 10% gain, so you're still making a decent little quick profit on it. Now, again, you could also, and like I said, in the scenarios where you might be in a primary base or a power play, you can sell maybe 80 or 90% of the stock and keep that small position. And I'll tell you right now, if you did that with something like Amazon or Yahoo or Netflix or some of these stocks that were relatively unknown names at the time, and you held 100 shares or a few hundred shares, or Cisco back in the 90s, you probably end up with a fortune just from that 100 shares or a few hundred shares. So it could turn out to be a very big long-term windfall for you. Let's just go through a few more of these names here. I want to look at WFC was very simple. I mean, we had earnings, went through, that came off in the morning. I love the bank itself. I'm just going to give you one of my other sort of rules of thumb. If I make a questionable buy, or maybe I stretch a little bit on a buy, in this particular instance, I felt like I stretched a little bit. And the reason why is what I really wanted to purchase was here on this big up day as we broke out. But I waited, and it ran up here and then pulled in on this very just short little pullback, natural reaction, of course, in hindsight. And as it turned up, that's where I bought it, right? So this isn't, in my opinion, I didn't make the greatest buy. I didn't buy it at the most opportune or the most precise level. And even though it's only off by a little, it's not off by very much. I don't like to lose money or let stocks drop much below where I made a buy that wasn't the best buy point. Okay, so I'm less flexible or I'm less forgiving with a stock that I didn't buy perfect. Now, if I buy a stock perfect and I look back and I go, "Wow, we got that just right at the pivot." Now, on that particular name, I'm going to give it a little bit more grace because I bought it as is in my opinion at the absolute perfect moment. Even though it may be at a new high, it's at the lowest point that I would get into it, because I'm only going to buy it if it moves to the pivot point. So it's as low as I could buy it. And this particular scenario, now of course, again, in hindsight, we're moving higher here. The banks all look pretty good here. Morgan Stanley had a good day today. It turned out to be a mistake. But if you're making mistakes, or you're breaking even on even half of your trades are break evens, and the other half are small losses, let's say between 3, 4 to 6%. That means that your average loss is somewhere in the neighborhood of 1.5 to 2 to 3%. You can make a lot of mistakes if you keep your losses to that level, and your mistakes are that minor. That's what I'm trying to do. I'm not trying to pump my ego up and say I'm right or I'm wrong and look back and feel bad about myself that, or feel stupid that I sold the stock at break even, it turned around and went up. If I were to operate from that emotional standpoint, I would commit suicide 20 years ago. I mean, I've been doing this for 30 years. I've been wrong about probably 100,000 times. I've also been right about 100,000 times, and I've made more money on the 100,000 times I was right than the 100,000 times I was wrong. So, and that's what it's all about. So getting your emotions out of here and, you know, just trying to keep those losses as small as possible. Now, remember, it's a balancing act. If you're going to be tighter with the losses, well, your batting average is going to come down. See, I don't mind a low batting average. I actually try to operate from a very low batting average and keep my edge on a risk-reward basis. Now, that may sound strange to some people, but I find that it's very hard to maintain a high batting average. If I can operate at being right only 3 times out of 10, when I've built in a tremendous amount of failure. I mean, how bad could I get? If I can't be right more than 3 times out of 10, then I know there's something wrong with the market. You see, it automatically lets me know. But you can easily have a much lower batting average than 80%. And some strategies need to be 80% to be profitable, 70 or 80%. I don't know too many traders that I've ever met in my 30 years that can maintain that type of batting average for any length of time. And when it finally goes bad, because they're so used to being right all the time, it usually really blows the wheels off. So I'm trying to operate a very low batting average. And again, for somebody who's new to this or is grappling with their ego and trying to get a sense of self-worth out of how many times you're right or wrong, it's a tough nut to swallow. You know, it really is. But you know, that's how I do it. Let's see. Let's take a look here. I know we have a few more. Of course, we have CTCT, which this one here. What I did with this one, and you can see, these are the 2 buy points. The first buy point was right here. This was a perfect buy, and I think the way I handled this, there's really only 2 ways to handle this as far as I'm concerned. We broke out. I doubled up as we took out the high here the next day. We followed through. I bought some here, then I doubled up here, and then as we ran up real quick here and rapidly, I took part of my position off, half my position off. And then as we started moving around here, I decided to move my stop up and protect about half of the gain. Now, you could very easily have just said, okay, let's go to break even on this one. That's fine too. But I look at it this way. I had a pretty nice gain on this quick lick here in just a few days. And now if I nail down a little bit more here and it pulls in, it's been moving sideways for a while. So I may get another opportunity to buy this as it sets up another base and just trade around the position. So what I did is as it ran up here, I originally moved the stop to break even. But as it started moving sideways and stalling out, I decided that I'm just going to crip this thing off a little bit. If it keeps going, fine. If not, I'm going to nail down some profit on this, and I'm not going to let this decent gain turn into a break-even or a loss. And then on this day here, you can see this is where we got knocked out of that second half, and there was about a 5% profit on that half. And of course, we on this beginning half, I don't have the numbers in front of me, but yeah, it ran up about 13-14% here. So we netted somewhere probably about 12% or so on this first half. So this was a fairly decent short-term trade. And now I'm looking at this as a reset here to maybe form a pivot. I still like this because this is one of those power play type situations. Although this isn't a classic power play, but it is a pretty strong name here. You'll see the weekly here is up around its upper end of the range here, so looking pretty good. Let's see what else. APAM. Now, another situation that, you know, I try to grade the trade and the quality of the setup and how big the base is. If you get a real big base that it's coming out of and it's really perfect, the fundamentals look great, again, I'm going to be more forgiving, okay? I'm going to be a little more forgiving. If it's a shorter base and it runs up real quick, well, then I feel like, you know, it's sort of a gift because it wasn't a real substantial base that it broke out of, didn't have a lot of time to digest. So a quick run-up is probably a good time to just take some profit. That's what happened here. I traded this little pullback buy off this short base. It was a little erratic, and then it tightened up quite nicely right here. and you'll see just as it starts to turn up. Now, again, for those of you that are new, do you see there's a theme here? It's very important to note that I am buying virtually every single time on the way up, not on the way down. Even when I buy a pullback, I'm not buying stocks that are falling. I'm waiting till they stabilize, and then as they start to turn up, I'm buying in the direction of my trade. Really, really important to understand to avoid being at a loss right away. If you're buying a stock that's falling, it's very, very seldom, if ever, that you're going to actually buy it and it just stops falling right then and there. Very often, usually, you're not perfect with your ideas. So, what you think's going to happen usually doesn't happen right away. Even when you buy in the breakout, sometimes it breaks out, it stalls out a little bit, and pulls in. It doesn't come in dead right on schedule. But in this particular instance, you'll see as we're turning up, and in almost every single trade that I do, buying on the way up. Now you'll see we came out here, moved up for a few days, moved sideways very naturally, still building sort of a handle area here, if you want to call it. And then we run up and we get a gap here. And when we get these gaps and the stock gets extended, we're coming off a short trade, I usually just sell right into them, and I take the money and run. If it turns out to just keep going, then fine. But again, here's your break-even point. So if you want to set your stop to break even, you could always have sold just half of it or a portion of it, move the stop to break even, and now you're free rolling. Again, this is going to feel great when the market keeps going up and everything's doing great, because you're going to probably be going to be right on a lot of these, and you're going to get bigger gains on the second portion. However, if you get yourself into a market that's a whipsaw market, or a market that's topping, or going into even a pullback of 4, 5, 6%, you're probably going to be kicking yourself, because now these are all come back and stop you out. Again, you can't get hung up on worrying about whether you're right or you're wrong. It's all about making money. It's all about what's good for your own style and what for your personality, and what works for you. Really, what works for you. You have to start off with a good foundation and have a good strategy. But how you apply that strategy and how you use that, you have to take that in and make that part of how you trade. And I have all different types of people that trade, and then I've taught over the years, and traders that have worked for me, and I noticed that nobody does it exactly the same. There are a lot of people that I've pumped out some carbon copies that are buying a lot of times right where I'm buying, and they've learned it quite well, but it's still very stylistic. Let's see here. And let's see, last but not least, well, of course, we have BRCD, which I sold, and this was on an upgrade. Very often I will sell on an upgrade. If a stock breaks out on a really big, on a major firm upgrade like a JP Morgan or someone who has a lot of clout like Goldman Sachs, I probably won't sell right away, just because, first of all, the stock broke out and it was already buyable. And if I get a big upgrade, those can last for a number of days and really get the stock out of the gate. But if the stock runs up, gets a little extended, and then I get an upgrade, very often I'll sell into that gap. This particular instance, I was kind of holding my nose. I felt like it was going to go higher, but just took the profit, and it hasn't even gone through its first natural reaction, really. So this stock probably shouldn't have been sold. Again, it moved up a little higher here. I want to bring out another point and just go back before I finish here, and we can go through a few questions if you'd like. When I was talking about the, not ignoring the smaller cap names, I find that, let's just go back and take a look at something like an AIQ. Let me just show you a few things here. I was actually buying this stock. Let's see here. Back here. And the reason why I remember is because there's and I'll get around to it. You'll see where I'm going with this. I was buying this stock back here, and I remember when I put it out as a, I don't remember if we put a breakout alert, or if we actually bought it in the portfolio. I'm trying to remember, but I remember I bought it, and I'm pretty sure we put it out with you guys. I remember that there was just no trading except mine, and I made a comment in the room. I went in the room and said, you know, am I the only one that's buying this? And very often, when that happens, I feel pretty confident that it's going to be a monster. Because again, what it tells me, it doesn't tell me that other traders are not good. It tells me that this is not followed, and it could be very inefficiently priced. But I noticed that, you know, if I put Netflix on there or something that everybody knows and everybody's talking about, you'll get a lot of activity. But when we go into these small names, sometimes I'm the only one buying them. And this just turned out to be a huge winner here. You can see it was a double in a very short period of time. It reset here and then came out again. We highlighted it here as well. And then, of course, over here tightened up and had a quick little move here. Most recently, and Mark Ritchie, if you're out there, yes, you were right. You know, we put this one here, and we put it on the service last week, and I was actually had a conversation with Mark Ritchie over the phone, and he said, or maybe yeah, actually you texted me, and he said that this is going to turn out to be a big winner because he noticed that when we put it out there wasn't a share that traded. And look what happened. Look at how it just exploded to the upside. Again, it's just the power of, you know, of inefficiently priced. And when they set up, just take a look at this setup now. You'll see how it tightened up here. And look at the volume. See how the volume is just non-existent? This is very, very bullish action. This is a stock that's under accumulation and is really, there's nobody looking at it over here. And then you might have to say to yourself, well, if nobody's looking at it, how does it do this? Well, see this big volume that comes in? See, this is what you're looking for. You're looking for these contractions and then the expansion to come afterwards. The right people that know about the company are coming into this company, not the retail guys. See here where it sets up right here in this nice little tight cup of handle? See where we get real tight here? Look at the volume. See how the volume comes way in? This happens time and time and time again, and I will give you a 100% certainty that it will happen long after every one of us are gone. This is not the cause. This is the effect. You can't hide this, okay? This is simply supply and demand, the law of supply and demand on display. And it can't be hidden. It's worked when Coca-Cola was emerging in 1935 and was the monster beverage of the 30s. Their earnings were up 400% or 500% a quarter, and the stock broke out of very similar setups, and it will work going forward for many stocks to come that will turn out to be leaders and turn out to be household names eventually down the road. So when you see these real tight setups and you see that they're really small names and they're thin, many of you may get scared from that, but I got to tell you, I get excited. I get real excited. And even if I only buy a small amount of shares, I would rather be in 1,000 or a few thousand shares of a stock that's going to double than have 10,000 shares of a stock that goes nowhere or goes up 3%, and I got to sit there and agonize while it just moves around, and I got this big position on. So you can offset some of the risk by taking smaller positions, but it'll actually give you just as much reward in the long run because these smaller names that are acting so well and have this power and these power plays and these type of names are going to give you much bigger gains than an IBM or Hewlett Packard or some of these names that you might feel more get more comfort from because they're household and big names. We have any questions? Yeah, Ralph. Ralph says, okay, great job, Ralph, and that's great to hear. Ralph says that he bought this stock here and he sold it yesterday, so that's excellent. I think it's a great sale. You know, it ran up here. I mean, what a great profit in a very short period of time. The stock ran up. Stock went up 33, 34% in 5 days. So that's a great lift there. Any questions on any of the material? Give you guys a chance if you have any questions. I know there's a lot of new people. Again, there's no such thing as a bad question. Yeah, I have a question here asking about going back to where I talked about the average gain, and a question asking how do we track that. Well, that's why we provide this software, the trading logger software that's on the platform, where you can go in and put your trades in, and then it will calculate for you, and you can see what your average gain and average loss is for the month, your largest gain, your largest loss, and you can break that down. And again, when I get where my average, where a stock runs up past my average gain, and I know my numbers are over the years are pretty consistent, depending on the market environment. But if I start running up above that average gain, and I get through that first one or two natural reactions, well, then I will raise my stop from there just because of that alone. Because what happens is once you get above your average gain, what's happening? You're improving your average gain, right? So you want to, that's the whole idea, is to improve your average gain. Keep improving that until you can't improve it anymore. It's really, you've optimized it. And at that point, you know, when you've been doing this for a while, when you've optimized your trading and something goes beyond what's optimal historically, you know that you're getting something, you're pushing the envelope there. Mike's saying, as a general rule, I'll raise my stop to break even when my gain equals or exceeds my risk. What do you think of that? Okay, well, that I'm going to tell you. I'm going to tell you the problem with that. If you use that as a hard rule, that should definitely be a general rule of thumb, but not a hard rule. And I'm going to tell you why. Let's just say you go into a stock and you find a very, very tight pivot point, and you determine that it's not acting right if it comes off 2 or 3%. You set your stop, let's just say at 3%. Well, does that mean that you're going to move it up if it goes up 6%? To me, that's not enough room. And I would then override it at that point. So if you're talking about a 5 or 6% stop and the stock goes up 10 or 12%, yes, then that in my particular trading, that would be a situation where I'm almost always going to move the stop up, if not break even, at least cut it in half, because I'm very seldom going to let a double-digit gain turn into a loss. And I'm certainly not going to let it turn into a big loss, or even the original loss that I had planned on. I'll tighten it up a little bit. So I would just use that as a soft rule, you know, depending. See, I'm looking for, I mean, if I can, I like to get in the stock and take a 0.5% risk if I could. I want the smallest amount of risk possible. So if I were to accomplish that, I don't want to punish myself for being so good at finding a low-risk entry point that I now choke off the trade and don't make much money because I bring my stop to break even if it only moves, you know, if it moves up just a few percent. So I'm sure you understand that. Dave's asking, or a comment. I think I finally use the alerts better. I'm going into the charts on each type of alert and studying it, then following the stock to a conclusion. Any other advice on how to use the various alerts to learn? When you say alerts, are you saying you're talking about our alerts that we send you, like the buy alerts and the buys and the sells, or are you talking about alerts on your trading platform? Yeah. Okay, well, I mean, of course, the best way to use the alerts that we provide are, you know, in real time, of course. Not everybody can trade in front of the screen and sit there all day. We have part-time and casual investors as well. The majority of you are pretty hardcore and you're sitting in front of those screens all day, but not everybody. I think the best way to use them, of course, is to you use the buy alert list as also as a buy list, because very often we'll get stocks that will go on buy alert that just for whatever reason we don't put them out as official buys, whether the stop is too wide or for whatever reason, but they still break out and they work. I mean, EFII's one in particular that I was looking for. I mean, here's my notes from before. I was looking for this to tighten up a little bit and then break out from there. Well, what ended up happening was it just ripped out of here. Again, still buyable though. I mean, still very buyable. I was a little concerned with, and I'll show you here, and I pointed this out, remember, last week, where you'll see there was some volume in here, a little bit of volume right inside this pivot point, and it was a little wide. I really wanted to see it quiet down first and then come out from there. And man, I got maybe got a little too picky on it, but I really like to see them as perfect as I can get it. But this one came out here, so that's a buy alert stock that came out. That's a great place to also get the ideas. I think if you're just starting though, you should really stick with what we're buying and try to get in there as quickly as you can as soon as they hit those prices. Now, what I've found over the years working with people is that even though I may put a buy price, a lot of times people don't buy at that price. They're just not convinced. There's not enough volume yet, or they just don't see it because it just starts to move and they can't pull the trigger. You really want to just pull the trigger as quickly as possible when it gets through that buy point and starts moving. You don't want to wait too much. You just get in there, and if you're nervous about trading it at that particular point, you take a part of your position. Maybe take a third of it or half of it, and then if it moves up a little more, you can then pyramid into it. So let's see. Yu Deng's asking a question on position sizing. Over the past month, I've made some decent profits, but I still want to do better. My question is that over the past 30 trades, I've taken a lot of half positions and then add to full position on subsequent setups at a point at which I was at a stage of equity exposure, which I was happy with. However, I was about 180% invested with 15 names. Would you say I should have just gone to full positions? Well, the way I look at it is this: if things are working, if you're going to just jump right to full positions, I'm going to do it for two reasons. One is that the setups are really crisp and the risk is really low. So I'm much more likely to put on a big position that I'm getting in at a very crisp, very tight setup, and my risk is small. That's what it's all about for me. If the risk is tight, then I put on usually a bigger position. If it's a more volatile name, then I'm going to try to adjust for that volatility a little bit and pad the position and not maybe take as much exposure. The other thing is if things are working. If things are working, the minute things start working, and just to point out too, the full position, half position that we put out, when we say half position, we're just using that for scaling purposes. It's not a real full position, half position recommendation as much as it is. We're just saying, okay, maybe this is early. Like for instance, I'll bring up an example, WebMD, or let's see. WebMD, this type of pivot that's low here, I'm pretty aware that this may come up to this high in this area and then stall out and have to reset and do a follow-on pivot. It didn't look like it was finished on the right side. So I'll say half position, thinking that I may be able to scale into this. Now, we've kind of grappled with this over the years and go back and forth. We're thinking about just putting, just not having any position sizing and just saying, when we add to it, just say follow-on buy, and we're still deciding whether we're going to change that verbiage and how we make those recommendations. But I'm looking at it more to communicate it to you guys that I'm scaling into the position as opposed to the real size. That's something, the exposure really is your personal choice, and it's not something that you want to make static. You don't want to just say, oh, I'm going to buy 5 stocks, 20% positions, and that's how I'm going to do it all the time. I don't think that's the best idea. If things are working, yes, then you just go and go to your maximum exposure. But if things are not working and you're getting stopped out all over the place, you need to pull back your exposure, your overall exposure and your position sizing. Let's see. You commented that you really like TRN. Can you elaborate on why you like the setup more than other setups? Well, it's not that I like it more than any other setup. It's just I either like a stock, you know, and I think it's got all the elements, or I don't. That doesn't really mean a hill of beans, though, because if I traded all the stocks that I just like so much, a lot of names wouldn't be in my portfolio, and I wouldn't trade. So I hold my nose a lot, but I just look at the chart and I look at the numbers. With TRN, we don't have it here in front of you right now. We've got really great fundamental numbers. We got great estimates in 2014, 2015. The past 4 quarters, a bunch of quarters have been really strong. Last quarter was up 59%. We got accelerating sales, rolling 2-quarter sales, and the most recent 3 quarters have accelerated. So you got a bunch of elements there. If you take a look on the weekly, you had a nice weekly setup here with last week with a close in the upper end of the range, an outside week. There's a bunch of reasons to like it. That doesn't mean it's going to work, and that doesn't mean it's any better than, you know, one that I'm plugging my nose and having a, you know, and getting a stomach ache over because it's so volatile. But I still think you know, it's set up, so I'm going to buy it. So I mean, I just try to just buy the ones that move first, get that first mover advantage, and try to buy some of the better merchandise. As the merchandise gets less and less quality and I really start stretching the envelope, you know, my antennas go up and I start seeing if things are, you know, if they stop working and I'm going out on the curve there, and maybe a lot of low price stocks start setting up, and some of the leaders have already topped, and we're getting into laggard stocks, you know, I just from that point then I start to position size maybe differently. But that's really it, though, the fundamentals. I mean, I'm looking for, I'd like to have, when I say something really has a high SEPA ranking, we're ranking them on the earnings, the sales, the margins, whether there's a breakout year. That's another thing with TRN. 2007 was $3.57. It went down. They went down to about 86 cents. 2010 came back up to 3.28 in 2012. Now in 2013. Looks like they do $2.64 and $5.99 in 2014. That's a very significant event, because now you've got an earnings breakout of a range that has been going sideways for 7 or 8 years, and suddenly you're breaking out of that range on the earnings. That's something that will attract institutional buying. That is a significant event when you break out of a range and you break out to that extent. Any other questions before we wrap this up? Yeah, Mike, I hope it was helpful. We'll try to cover as, you know, topics as we can. It's been sort of you know, busy lately. We have had a lot of trading going on, so we haven't gotten to as many tutorials as we would like to. But we'll cover them over. Just hang in there over time. You know, when we start getting some downtime, if we go into cash or the market starts getting more difficult, we'll do more. We'll do some more tutorials also. Yeah, well, this is an issue that we all struggle with. I mean, because none of us are perfect, and this is really the what's inherent in trading stocks, is that you're never right. You know, you're always, in hindsight, you're always wrong to a certain extent, because you're not going to get the high, you're not going to get the low. So I think it's one of the reasons why a lot of traders fail, is because they just can't handle the emotional side of it and don't really go into it with the right frame of mind of what trading is about. You know, it's about making money. It's about making more than you risk and doing it over and over, and doing it in a way that is the easiest for you, is enjoyable, and is something that makes sense to you and that fits your personality. So again, you know, some traders like to go in and out and do a lot of short-term trades and feel like they have a lot of control and have the confidence to be able to trade the swings. And then there's other people that are really, those swings really give them heartache, and they want to just hang in there and set their stop and let the stock do what it does, and maybe look for a bigger gain. There's all different types of personalities and types of approaches that you can put within a strategy. Even though you're doing the same strategy, you can still do it in a way that fits multiple different personalities. So you know, that's really something that I think that is the intangible thing in trading that is so difficult for a lot of people. You know, I've been doing this for so long that, you know, it's second nature for me to go through these I mean, I don't even go through these emotions. They don't really bother me too much. Don't get me wrong. When the stock goes up and I sold it, you know, I'm certainly saying, damn, I wish I held that. But it's not going to affect my trading or my thinking going forward, and it's certainly not going to put the type of pressure on me that's going to make me make mistakes. So just hang in there and keep improving on this stuff. Yeah, Linda. You're welcome, Linda. Now, market's still looking pretty good here. We were able to get, after that distribution, we were able to get into new high ground here, which took the risk model right back to the general market being back positive. However, with this gap and running right back up, it may pull in here. It's very possible, and it's a good sign that it came right back. There wasn't much volume yesterday compared to the sell-off, but we've seen this happen time and time again. We just get these pullbacks, get these sharp pullbacks, and then very shortly after it just comes right back. And that's why you really just have to stay off the market and stay on the stocks. I mean, you'll know when the market's really getting bad, because you'll just start getting stopped out of everything, and the setups will disappear, and you'll see pivot failures. Then after the pivot failures, if it really gets bad, you'll see base failures, and then you'll know that it's just not a time. It's a time to step aside. Right now, there's follow-on setups here. So as long as you keep getting setups, you keep playing them, and you keep trading them until things change. All right, I'm going to wrap it up. It's 5:30. I'm going to go eat dinner. I'm sure some of you guys want to eat dinner too. I'll talk to you guys soon, and of course, I'll be in here next week for our normal session, monitor the platform for the rest of the week, and hope you guys have a continued success this week. All right, take care. Bye-bye.